In the early 1900s, commercial banking operated as a closed circuit. These institutions functioned as risk-averse clubs, catering to a wealthy elite who could back every dollar borrowed with significant physical property. This system left a massive demographic in the cold. Working-class laborers and new immigrants, the people physically building the country, were viewed as too risky to serve because they lacked traditional collateral. Because the financial system relied on this barrier of exclusion, the local economy lacked real depth. The vast majority of the population was forced to operate without any institutional financial safety net. On April 18, 1906, that fragile system was tested. A massive earthquake and a series of uncontrollable fires leveled San Francisco, effectively wiping out the city's infrastructure in a matter of hours. The response from the established banks was immediate paralysis. They kept their surviving vaults locked, fearing that any attempt to open them would lead to a total loss of their remaining reserves. Amedeo Giannini saw the ruins as the bank's new office. While the established players waited for the smoke to clear, he prepared to move his operations directly onto the docks to keep capital moving when the city needed it most. The failure of the traditional guard during the fire created a massive economic vacuum. It provided the first real-world stress test for Giannini's unproven inclusive model of finance. As the fires approached his vault, Giannini and his stepfather loaded the bank's cash and gold onto wagons. They hid the currency under crates of fruit and vegetables, driving the makeshift armored car through the chaos to safety. Days later, he opened for business on the Washington Street wharf. With a simple wooden plank for a desk, he began offering immediate financial support to a population that the rest of the industry had abandoned. Instead of a collateral loan backed by property, he issued unsecured loans, handing out cash based on a handshake and community reputation. The gamble paid off. Repayment rates were perfect, and the working class rewarded the bank with massive deposits, scaling its balance sheet. Giannini had successfully converted a disaster into a permanent financial asset: public confidence. This ironclad trust became the operational blueprint for the eventual growth of Bank of America. By the 1920s, Giannini's expansion reached New York, placing his growing empire in direct competition with the most powerful figures on Wall Street. J.P. Morgan Jr. viewed the outsider with open hostility. He launched a smear campaign designed to tank the stock of Giannini's holding company, Transamerica, hoping to crush the bank's expansion before it could take root in New York. Giannini fought back with a massive proxy campaign. He successfully rallied his base of small-scale, working-class shareholders to outvote Morgan's institutional loyalists and maintain control of the board. Giannini had successfully defended his territory against the king of Wall Street. He proved that a bank built on the loyalty of its customers could withstand an aggressive assault from the industry's most powerful elite. By the 1980s, the bank had drifted far from its origins. It had become a bloated, central bureaucracy that prioritized corporate growth over its original mission of community support. This internal decline left the bank vulnerable. Corporate raider Sandy Weill recognized the weakness and launched a hostile takeover bid, aiming to absorb the institution and streamline it for profit. Leadership fended off the takeover by deploying a poison pill. They intentionally issued new shares to dilute their own value, making the bank too expensive and unappealing for Weill to acquire. In 1906, the bank survived on the strength of its public reputation. By the 1980s, it was staying alive through boardroom technicalities that actively damaged its own shareholders. Leading up to 2008, Bank of America pursued a policy of unchecked expansion. The goal was massive scale at any cost, often at the expense of sound lending practices. This relentless drive for scale led to the acquisition of Countrywide Financial and Merrill Lynch. The move filled the bank's balance sheet with billions in toxic, high-risk mortgage assets. When the housing market collapsed, these assets turned into a massive liability. The resulting panic pushed Bank of America to the edge of insolvency as its market value evaporated. The bank, founded to help workers build homes, was now heavily invested in the very predatory loans that led to their foreclosure. When the market turned, Bank of America was left with a balance sheet of toxic debt and no reservoir of community trust to fall back on. The $45 billion in government funds provided a temporary floor, but liquidity alone couldn't stop the bank's reputation from hemorrhaging. They needed a public signal that the institution was still a viable bet for the future. That signal came from Warren Buffett. His $5 billion investment functioned as a vital vote of confidence, convincing a panicked public that the bank would not be allowed to fail. Today, Bank of America serves 68 million customers, yet it consistently faces high volumes of regulatory fines and consumer complaints regarding unauthorized accounts and excessive fees. Size and government bailouts can make a bank too big to fail, but long-term institutional survival still relies on the logic forged on a wooden plank in 1906. A bank's only real currency is the trust of the people it serves.